In this video, we're going to talk about building portfolios. How do we ultimately select a portfolio? So let's kind of go back and review some things we did in some other videos. We had talked about creating a portfolio that has a certain percentage, in this case 50% stocks, 50% bonds. You can create one that has 85% stocks, 15% bonds. But essentially what we're looking at here is once you have a portfolio, once you have a selection of assets and you start to combine them, what does that combination look like? So in this first example, we're just going to talk about a 2-asset set portfolio. Again, if you remember, we had 100% bonds, and you can have 100% stocks, and all these dots in between represent portfolios that combine those two particular assets. So this is what's creating a universal set, if you will, or a portfolio set of potential investments. These are combinations, if you will. So what we have when you have these combinations is we have to choose which assets, which portfolios are better than others. So if you look at these portfolios, you can see that we have a circle here. This top line, this top set, if you will, of dots represents what we refer to as the efficient set. What does efficient set mean? An efficient set means that there are no other portfolios that have a higher rate of return and lower risk. So again, this is just two combinations, if you will. So let's take a look at the group that we had before. In a previous example we had talked about. Here we have the efficient frontier sets of 2 assets, A and B. Again, here you see these are all the possible combinations of A and B. So let's look briefly at this point right here. This blue dot right here above the 0.1 as far as standard deviation. Now, is there another asset that we could buy that would give us the same amount of risk but give us a higher rate of return? And of course, you can. If you go to the upper edge of this, called the efficient frontier, this portfolio has the exact same risk as this portfolio, but has a higher rate of return. So it is a better investment, if you will. In the investments world, we refer to it as being a dominant portfolio. It dominates this one because it has higher returns. Excuse me, and the same level of risk. Now, what creates this shape of portfolios? What creates the shape is correlation. So what you can see here is we have this blue line that connects 100% bonds to 100% stocks. Everything between these 2 points is what we refer to as a positive or long investments in those 2 securities. So here's 100% bonds, 0 stock. Here's 100% stocks, 0 bonds. And everywhere between there are long positions. Now, you can invest out here on this end, on this side of the 100% bonds, but what this implies is a short sale. That is that you're actually going to be borrowing some stocks, right? Selling those stocks, getting cash, taking that money plus all the rest of your money and investing it in bonds. But we're interested right now in this connection between the 2 dots. If a portfolio was perfectly positively correlated, the combination line would be a straight line. But as we get less and less than 1, right, as we're moving in here, you see that there's a curve that forms. And again, everywhere between the points is a good long position. And again, this position says the correlation is 0.2. 0.1 or negative 0.1 implies that we actually would touch this risk-free rate over here. But again, the shape of the curve is determined ultimately by correlation. And what we know from real data is there is no data, there are no stocks that are perfectly negatively correlated. So this curve can't exist. We also don't have portfolios where the correlations of the securities are plus 1. So this straight line doesn't exist. So somewhere in between there is this curvilinear function, right? So that's where we ultimately end up with this efficient set. If you now transfer our topic here from all the 2-asset portfolios you could create to looking at the entire universe of assets, what we now have is this bullet-shaped curve. Inside the curve are all these individual assets. Some of them are even portfolios, right? So there's portfolios, individual assets out here. But again, you won't find any securities out here. There's nothing exists. Nothing in the world exists out here to the left of that red line. So again, we come back to, well, if you're an investor and you want to buy a security, what security would you buy? Well, you want to pick the best. Well, the best is going to be on this efficient frontier. And again, it starts over here. The far point on the left here is what's called the minimum variance portfolio. It is that portfolio that has the least amount of risk possible, and everything upward and to the right is on the efficient frontier. So these are all the choices that you can make of the investment world. Again, as we mentioned, that is the efficient frontier. So the only thing, again, just to kind of reiterate, the only investments that you would be interested in are on this upper red line. That's what, again, we refer to as the efficient frontier. So let's take a step away from this for a second, and let's talk about returns again. Let's come back and talk about expected returns. What is it that you expect to get? Well, the first thing that you would expect to get for a return, obviously, is a calculation, right? The expected return. But from time to time, there's something different that you can receive, right? There's something extra, an unexpected part. Could be positive, could be negative. But the return on a security is a combination of what you expect to happen and then the unexpected, the surprise that you can receive. Diversification, as we've talked about a little bit earlier ago, although we didn't truly identify it, is when we can reduce the variability, right? Reduce the risk of returns without reducing expected returns themselves. This typically happens because of low correlations, right? Essentially what's happening is there are stocks that have these unexpected events, and these unexpected events are not related to each other, so they offset each other. That's what diversification essentially is. It is the offsetting of outliers of returns so that there is a reduction of risk. We actually saw it mathematically in one of the graphs or one of the tables where we saw that by combining these assets that had negative correlation, we would find that we could get a pretty dramatic reduction in risk. So that was a picture of risk itself. But how does this really happen? So let's think about investing in assets. So there was a study done where they looked at rates of returns on investments in the New York Stock Exchange. And this was done in I believe is in the late 60s, early 70s. But essentially what they did was they took all of the stocks in the New York Stock Exchange and they said, look, if you took any stock at random, what is the average standard deviation? What's the average risk of a stock? And they found that when they did this, a one stock portfolio on average, and if I'm not mistaken, I think the number was about in the ballpark of around 48 or 49%. But then they said, what will happen if we combine two stocks together? So they randomly chose two stocks, made equally weighted portfolios, and did this hundreds and hundreds and hundreds of times, and then found the average risk of those two stock portfolios. And what they found is that even by choosing random stocks, there was a reduction in risk. And they continued this process of creating bigger and bigger stocks. And what they found is this red line is actually the risk, the portfolio risk. It continues to fall. So as you make bigger and bigger portfolios, the portfolio risk declines. So what is it that's actually happening here? Diversifiable risk, or firm-specific risk, that is the risk that's disappearing. It's dwindling away. Why? Because the things that we're combining are not perfectly positively correlated. However, you cannot get below a certain level. There's a certain level with this set of stocks that no matter how you combine them, you won't be able to get below a certain level of risk. So that level of risk that you're stuck with, right, in the end is what's referred to as systematic risk or market risk. So systematic risk is any risk that affects a large number of assets, each to, a bigger or less degree, really doesn't matter. But an unsystematic risk usually only affects a single asset or small group. That is, it is firm specific or rather unique. And unique things are ultimately diversified away. Essentially, that's the way statistics works. Statistics essentially is a function of averaging. So these unsystematic things are outliers. Some are positive, some are negative. So when you average them, they ultimately disappear. So when you have things that are systematic, right? Economic conditions, sometimes political things, inflation, you can't get rid of those things, right? Everybody is affected, so you can't get rid of them. They are systematic. But other things like lawsuits, bankruptcies, those things are company specific. So when those things happen, those events will create an offsetting, if you will, so that in the end, we will have a reduction in risk because the outliers will offset each other. So total risk equals systematic risk plus unsystematic risk. Standard deviation is that measure of total risk. If you have a well-diversified portfolio, what defines a well-diversified portfolio? If you have a portfolio that's got 30, 40, 50 stocks in, it is probably a fairly well-diversified portfolio. In that portfolio, the unsystematic risk should be very small. So the total risk for a diversified portfolio is essentially equal to the systematic risk. So again, how can we say that in a different way? Essentially, if you have a portfolio that is very well diversified, there is no unsystematic risk. There is no company specific risk in that portfolio. So the total risk at that point is also equal to the systematic risk. So when many stocks are combined in a large portfolio, again, firm-specific risks average themselves out. The systematic risk, again, will affect all firms and will not be diversified away. So this brings us to a point, all right? The risk premium for diversifiable risk is 0. So what does that mean, right? Remember what risk premium means, right? It's the excess return. What do you get paid for taking this risk? If it is a diversifiable risk, the risk premium, the payment for it is 0. So investors are not compensated for holding firm-specific risk. They will not be compensated for holding small portfolios. They need to diversify away. If the diversifiable risk were compensated, then you could buy stocks, you could earn additional premium, diversify away, and actually eliminate the risk. And it just wouldn't make any sense. So because investors can eliminate firm-specific risk for free just by diversifying away, they're not going to require to get paid for it. So the risk premium of a security is determined then by its systematic risk, and it doesn't depend on its diversifiable risk. Again, this implies the stock's volatility, which is total risk, is not really very useful in trying to figure out how you should get paid, right? The risk premium. So standard deviation is not an appropriate measure of risk for an individual security. There should be no clear relationship between volatility and returns. So to estimate a security's expected return, we need to find a measure of a security's systematic risk. So let's see how we may work our way through thinking about building an optimal portfolio. Now we're going to combine some securities. We're going to combine risky securities, a portfolio that has risk, with the risk-free rate of return. Now, to do this combination, then, we obviously need to draw a line that shows all the combinations of the risky portfolio and the risk-free. That's what we get here with something, this thing's called the capital market line. It shows us that if you drop this line down from the risk-free rate and kind of just let it drop down, it's going to touch the old efficient set here in only one dot. There's only one dot that represents that portfolio. That dot is what we're going to refer to as the market portfolio, right? It represents the best risky portfolio that you can buy. In fact, there is a statistic that's called the Sharpe ratio, and this Sharpe ratio should be at a maximum point at that dot. So that gives you the Sharpe ratio. Sometimes it's called the risk return reward ratio. It gives you the best combination of risk and return. So now, how do you pick a security? Well, if you remember, this red line used to be the efficient frontier, but it's no longer the efficient frontier, because now instead of buying this red one here, there is an asset or a portfolio up here higher. So we have this capital market line now becomes our efficient frontier. It is the combination of all of the risky portfolio, that market portfolio, and the risk-free rate of return. So we have created now a choice. Where would you like to be on this choice? You can choose anywhere on this line, and where you choose is dependent on you. Now, that's really not part of where we're going with this, but that is how ultimately a person would choose a portfolio. These are the only good choices on the capital market line. You need to find the one that will serve your purposes best. So that's all for this video, and I'll see you in the next one.